Hi, I'm Tin van der Putten from KH Lim, Limburg, Belgium. And as already promised in the intro, I'll talk you through some financial terms. After this seminar, I hope it will be easier for you to convince your shareholders and your financial department to make them decide to do that particular investment in new equipment you want to better operate your cold store. As promised, I'll talk you through some financial terms and I'll give you some examples. This I will do on a break-even analysis, on the payback period of the investment, on the return of the investment, and the net present value, the internal rate of return, and the total cost of ownership. On top of that, I'll explain you what a life cycle analysis is and what life cycle costs are. A break-even analysis. What is a break-even analysis? Before making an investment, it is always good to calculate in advance where you have no gains and no losses. In other words, where the result equals zero. This is a quick and rather easy calculation. The disadvantage of this method is that it does not take the time value of money into account. For example, we have fixed costs of 1,000 euros. Fixed costs are costs that you even have if you don't sell anything. For example, rent or personnel. Variable costs are costs that you have per unit you sell. For example, materials and labor. In this example, the variable costs are 5. And the fixed costs are 1,000. The selling price is 10. So, where is the point where I don't have any gains or any losses? This point is the point where I sell 200 units. If I sell more than 200 units, I'll have a profit. If I sell less than 200 units, I'll have a loss. Payback period of the investment. This is the length of time required to recover the cost of an investment. How do you calculate it? You calculate it by dividing the cost of the investment by the annual cash inflows. For example, if I have an investment of 10,000 euros, I'll have an annual cash flow of 2,000 euros, I'll have a payback period of 5 years. This is also a quick and rather simple method to calculate. The disadvantage is that it does not take the time value of money into account and also not the profitability, as it ignores any benefits that occur after the payback period. The return on investment. There are several ways of calculating the return on investment. In this example, we'll give one. The return on investment, or the accounting rate of return, is defined as the average accounting income to the investment. So, you calculate it by taking your average accounting profit divided by the initial investment. In this example, we have an investment of 130,000 euros. This investment will last for 6 years. After the 6 years, I don't have any value left. So I have an annual depreciation of 21,667 euros. Our annual income is 35,000 euros. The annual profit is 13,333 euros, or the 35,000 minus our depreciation. This gives a return on investment of 10.26%, or the average accounting profit, which is 13,333, divided by our initial investment of 130,000 euros. What are the advantages of this method? It's easy to calculate and it takes into account the profitability of the investment. But it does not take the time value of money into account, and there are different ways to calculate this return on investment, so it's not consistent. The net present value. This method is one of the most reliable methods used in capital budget. I have to start you by explaining that €1 in hand is not the same as €1 in hand in the future. And this is what the method does. It calculates the value as of today of a future project. You can see the formula on screen. There are two formulas. The first one is used when you have the same savings of all the years of the investment. The second one is used when you have different savings all through the project's lifetime. S is the expected net cash received at the end of the year T, or the annual savings. I is the discount rate, or the targeted investment rate of return. N is the project duration in year. The advantage of this method is that it takes into account the time value of money. The disadvantage is that it is based on estimates, as all the methods we already talked about are. But the disadvantage of an estimate is that you won't know that you'll get it until you get there. An example of the first formula of the net present value. I have an investment of €243,000. This investment will last for 12 years. For example, we changed our lights we had in our coal store into new lights that will last for 12 years. We used LED lights. Our annual savings are €50,000. This means that we will save money for 12 years. The expected rate of return that shareholders have targeted is 10%. So, the net present value of this project is €97,684.59. And as already said, if we have a positive net present value, we should make the investment. The internal rate of return. It's a combination of the break-even and the net present value. Is that discount rate at which the net present value of an investment becomes zero. So you discount your future savings and you calculate them as of today, and the I that makes this net present value zero is the one you are looking for. As you can see in this complicated formula, it's not easy to separate or isolate your I in the equation. Therefore, you have to do it by trial and error. If your net present value is greater than zero, you have to increase your I. If it's smaller than zero, you have to decrease your I. If the net present value is close to zero, you become your internal rate of return. For example, I have an investment in which I have to put €230,000. The savings in my first year are €65,200. The savings in my second year are €98,000. The savings in the third year are €73,100. The savings in the fourth year are €55,400. If we have a targeted rate of return of 10%, we have a positive net present value. In other words, we should make the investment. Our net present value is approximately €20,000. So, net present value is positive, we have to increase our I. If we take an I of 13,000 euros, we still become a net present value that is positive. So we increase our I again. Then we become a net present value which is negative. What do we have to do? We have to decrease our I. And then when we make the calculation and become an I of 14.5%, then we have a net present value of approximately 0. So our internal rate of return is approximately 14.5%. The last term in financial aspects I want to talk to you about is total cost of ownership. This goes way further than the things we've already explained to you before. It includes all the costs of owning a particular investment, even opportunity costs, social costs, ecological costs. And this is the perfect way to get on to our life cycle costs. Life cycle analysis. Life cycle cost. The life cycle cost expresses the overall cost from the investment from the owner's perspective. In other words, what does it cost the owner to purchase the new investment, to operate it, and to liquidate it when the investment is not useful anymore? Or, in other words, the cradle-to-grave principle. We are not only looking into detail to the purchase costs and the costs for operating the investment, but we should also investigate into the other costs relating to this investment, namely the environmental impact of operating the investment, but also the environmental impact of the production and the environmental impact of the liquidation of this investment. As already said, it goes much further than all the things explained before. Last slide. The life cycle analysis. When performing a life cycle analysis, we have to compare the life cycle cost of a particular investment to a more basic or base case investment. Normally, the new investment should be more expensive in purchase but have a longer lifetime value because of the fact that it's more efficient. It has a higher efficiency design. The main purpose of this way of working is to conclude whether it is worthwhile to make the investment and to put more money in it compared to the base case investment. I hope things got more clear to you. If not, please contact me. It will be great for me to help you further on this.